the second thing, which is IFRS financial statement, which will give you accounting profit. And you have tax statements, which give you taxable profit. Now, what happens that in every company, you prepare two sets of financial statements. Like you will prepare two income statements, you will prepare two balance sheets. One income statement is prepared for the shareholders, which usually is IFRS based. And the other financial statement, income statement, balance sheet, will be prepared for the tax department, which will be not based on IFRS, but that will be based on your local tax legislation. Like IFRS is applied to 160 countries, and almost every country has a different tax regime. They have a different tax code, different tax law. So what happens that in IFRS, you decide your accounting policies. You decide how will you make your financial statements. But in tax statement, you prepare financial statement according to the tax department. How would they allow? For example, let me make this thing again here. I'll copy paste this down. We keep it here. And I call it, this is my IFRS statement. And when I call it IFRS statement, and I call it accounting profit, okay? So this is my accounting profit. And then I need to prepare my taxable profit. And it is quite possible that I use the word there, admissible expenses, allowed expenses. This is something which you need to consider, because in a business, you may record many expenses, and sometimes those expenses are not allowed by the tax department. I mean, very common example, which we always start with, I mean, that's the most basic example, is about entertainment expenses, okay? Now, within your other expenses, let's suppose there are some entertainment expenses, which means that you had some business guests, you had some business delegates coming to your city, coming to your country, you take them out, and you spend some money on entertainment. This expense was allowed by the management because the management decided to entertain its guest. But the IFRS will not, but the tax department will not allow it. Not in any country. I mean, throughout, wherever you see tax regime, entertainment expenses are not allowable. Nobody allows that. So what will happen when I prepare this statement for the tax department will see, and they say, you know, out of this $10, which you see here, how much is your entertainment? Their $4 were entertainment. They will take it out and they will say, you have to pay this much of tax. So I'm saying that my profit is 20, and they will say, no, your profit is 24, because they are not accepting this expenditure of entertainment. It's an inadmissible expense. Similarly, there may be some other expenses for which I may not be able to produce some documentation. Again, they will not allow that. Where is the document? You know, I said, you know, I spent the money, but I don't have the document. Okay, then take it out, because without that, they will not allow. Entertainment, like I tell you, how they do not allow it. The tax department, how do they work? They think like that. These are your sales, like, you know, $150. This is your revenue. You can only write down the expenses which were necessary to generate this revenue. Okay. So all the expenses which were incurred to generate this revenue, you only write down those expenses. You cannot write down other expenses. You have to pay tax on that. That is not allowed. So entertainment is not allowed. Many other things are not allowed. So what will happen, that it is a very common scenario that your...
Sir, can you please repeat the sentence?
No, I said that there are many expenses which you, in your company, you register them as expenses because you have seen them. I give you one very simple example. Okay. Let's suppose that you have a transport company and you have some heavy vehicle which is coming on highway from some other city to your I don't know, warehouse or whatever. And the tire burst on the road. There is a tire burst on the road in the middle of nowhere. And your driver calls you that, you know, I've got this car, maybe there is a tire burst, maybe there is a car, the car has broken down. And you ask him that, you know, find out something, some garage, some place on that highway and repair the car and then come back. So he spent some $200, and it is quite possible that on that highway in the middle of nowhere, they would not give him any tax document. They would not give him any receipt. They would not give him any invoice. He spends the money. He comes back to your office. You in good faith accept this expenditure because somehow you know that it was damaged, because he shows you the new tire, which he just put on the car. But because you do not have the document, you cannot claim it to the tax department. So there will be many, many, many other reasons, possible reasons in practical life as well, which will create this issue that my IFRS profit is different and my tax profit is different. In some cases, IFRS profit could be more. In some cases, tax profit could be more. It is not necessary that every time this will be more. It is possible that this could also be more, this could also be less. What I'm just trying to focus you, that this profit, which you calculate here, it is an outcome of the income and expenses. And the expenses, the list of expenses will not match. You write down here 15, tax department will only accept 14 out of that. You say my distribution cost is 10, tax department will say only 9. So tax department, what I said that, what they believe, how do they think, how do they work? They say, if you generate this $150 revenue, they will only allow the expenses which were necessary to generate this revenue. You know, if I took my guest on a dinner and I paid them some $100, tax department does not accept this thing, because they say that this $100 which you are paying for the dinner, it is not for generating this revenue. Okay. This is not cost of sale. This is not cost of material. This is not cost of electricity. You go out, you may spend 200, you may spend 300, you spend it from your pocket, but you cannot show it as expense. I mean, you cannot have parties and then take benefit from the government, because every time when you write down an expense, when you come up, you say, oh, let's write down 20 here. So the government, your tax expense goes down, government income goes down. So money goes out of the pocket from government. Why should be government losing 30% on your parties? You say, okay, I did a party, I'll make it minus 30. When you make it minus 30, the government money goes down. Government will not accept it. They say, you are going and taking dinners and 5 stars or 7 stars or I don't know parties, and they have to suffer. They do not, they will never accept that entertainment expense. And like I said, many others. So what I wanted to show you and make you familiar with, that you prepare 2 financial statements. This one is IFRS based. This is based on our company policy, okay? Our accounting policy. This is the true reflection of our this is the true reflection of our activities. I'm using the word true reflection, which has been communicated to the shareholders, which has been approved by the shareholders. This is what the tax department is accepting. They have their own rules. Now there is some difference. The tax which I have to pay according to, in my opinion, is called minus $6. But the tax which the tax department will claim from me is minus $7.5. So there's a $1.5 difference, and that is called difference. And I would call it here, in this case, permanent difference. I'm using the word permanent difference. Permanent difference means that this difference is there and it will remain there. I cannot claim back this difference. Sometimes you do have temporary differences. What does that mean, temporary differences? This is our topic actually for today. I thought that I had to pay 6, but the tax department comes and says you pay 7.5, and I did pay them 7.5. So I paid them 1.5 more. I paid more, and it will never come back to me. But in case of temporary differences, what happens that these differences cancel out each other in the long run, and these stay. They are permanently cancelled out each other. What does that mean? In case of temporary differences, let's suppose that you have a $1 temporary difference. A $1 temporary difference means that I may be paying $1 more this year, but next year I will pay $1 less. So I'm not very much, hurt or affected. It looks like that, okay, I'm paying more now, but next year I will recover it. That is called temporary difference, which means difference is there, but it is temporary. So in some period you pay less, next period you pay more. In some period you pay more, next period you pay less. So such type of differences are called temporary differences. But permanent differences are never resolved. Like this is an example of permanent difference because of that entertainment expense, okay? Because of that entertainment expense. They will never accept it in future. Like they don't accept entertainment expense this year, and they will also not accept it next year, and not even the next year later on. So this one is my expense. I have to pay it from myself. They will not accept it. These are called permanent differences. However, there are some type of expenses which I'm going to discuss later on in the next half of this lecture, which are called temporary differences. And temporary differences, they cancel out each other. So in one period you pay more, another period you pay less, so they balance out each other.